Good morning, everyone. Thank you for joining us today at the launch of the IMF Regional Economic Outlook for the Middle East and Central Asia. Our esteemed panel today will focus on the MENA region. But before we turn to the panel, I would like to invite Ms. Alia Zaroni, Chief Operating Officer at the DIFC Authority, to give opening remarks. Thank you.
Good morning, ladies and gentlemen. On behalf of the Dubai International Financial Center, it is my pleasure to welcome you to the launch of the IMF Regional Economic Outlook for the Middle East and Central Asia. We are honored to host this important dialogue once again, continuing a tradition with the IMF of many years of long-standing partnership that reflects our shared commitment in fostering informed, inclusive, and forward-looking economic conversations. So as you recall, in the May 2025 edition of the Regional Economic Outlook, the IMF offered what I would call a constructive assessment of the challenges facing our region. It highlighted a complex landscape shared by rising trade tensions, extended oil production cuts, and geoeconomic uncertainties. Yet the report also emphasized a path forward. It called on all policymakers to rebuild fiscal buffers, accelerate structural reforms, and prioritize economic diversification. Importantly, it urged governments to leverage on the green transition and digital economies and to empower private sector-led growth as a cornerstone of resilience. From May to October, we've seen that the global landscape continued to evolve. We've seen many new shifts in trade policy, fluctuations in the energy markets. We've also seen new geoeconomic dynamics happening. These developments underscore the importance of our dialogue today. So we look forward to hearing how the IMF's updated analysis addresses these challenges and what recommendations are being put forth to obviously enhance our resilience and unlock sustainable growth across the region. So we'll be hearing from Dr. Jihad and the esteemed panelists shortly, and I would like to take this opportunity before I end my short note to extend sincere thanks to the IMF, led by Dr. Jihad Azur, Director of the Middle East and Central Asia Department, and his team for their amazing work and their continued partnership. I would also like to thank you all for joining us today, and I look forward to insights and ideas that will not only eliminate the challenges, but also inspire the solutions that we need. Thank you so much, and wishing you all a great and engaging discussion. I hand over now to Joumana to begin the panel. Thank you.
Thank you. Thank you so much. What a beautiful summary of the Regional Economic Outlook as well. We don't have to do the panel anymore. My name is Joumana Bercetche. I'm the anchor for Bloomberg Television out here in the region. I host a daily show in the morning. Hopefully you watch it. And thank you to the IMF for inviting me back. The last time we did this was back in May, and the world felt a little different then. And actually you can see that in the updated forecast. I'm just going to give you some of the numbers that came through from the latest world economic projections released by the IMF last week. Global growth is now projected to slow slightly from 3.3% last year to 3.2% this year and 3.1% in 2026. But these forecasts do represent an upgrade from where the prior forecasts were, an upgrade of 0.4 and 0.1 percentage points respectively. So an upgrade from April has come through. Specifically for this region, and when I say this region, I'm talking about Middle East, North Africa, GDP is now projected to reach 3.3% this year in 2025. That is up from 2.1% last year, so a sizable increase from 2024. And also that constitutes an upgrade of 0.7 percentage points versus original projections back in April. They're also forecasting 3.7% in 2026. So the theme of the report is more resilience, will it last? Resilience amid uncertainty, will it last? And that's what we're going to be discussing on the panel today. So to my left, Jihad Azur, Director of the Middle East and Central Asia Department from the IMF, a man who needs no introduction. To his left, Mr. Tariq Sultan, Vice Chairman and CEO of Agility. Then we have Nasser Saidi, President of Nasser Saidi and Associates. And then we have Jean Ames, the Professor of Economics from the NYU Abu Dhabi. And also, just one thing, housekeeping, if you do want to post about this session, you're very welcome. Hashtag IMF MENA is the hashtag that we're using. So, Jihad, I'm going to start with you. What is driving, quite simply, this better than expected performance this year?
Thank you very much, Joumana. It's a great pleasure to be here, and thank you for hosting us. And also, I would like to echo what you said. This is a great partnership, and we look forward to continue collaborating together. Joumana, this year it's an exceptional year. It's a tale of two cities. It's a year of shocks. It's a year of uncertainties. It's a year of high level of volatility. It's a year of conflicts, but at the same time, when we look at the economic performance, you see that it's a year of resilience too. Despite all the events that, if you put them on one column, and you see how the economic indicators have behaved this year, yes, it raises the question why. This year, the growth is going to be upgraded for most of the countries in the region, both oil importers and oil exporters. And the main reason for that in the oil exporters is the performance of the non-oil sector, especially in the GCC, in addition to the increase in oil supply with the unwinding of the OPEC Plus. And for the oil importers, it's the performance of certain number of sectors like tourism, agriculture, and remittances. But it's also a year where access to finance were made available. Financial conditions were better this year compared to the last year. If I take only one indicator, which is the level of issuance, we are already around $48 billion of issuance up until end of September, higher than all 2024, knowing that 22-23 were very challenging for countries in the region to access markets. It's a year also where inflation is getting under control in most of the countries, and even those who are still having double-digit inflation, inflation is going down. Therefore, it's a year of resilience. But again, it's a year of high level of uncertainties. And even if the trade shock was limited on the region, trade measures and tariff measures are still unfolding. And even if the direct impact is limited, maybe we are going to see indirect impact. Also, the economic fundamentals may change that could lead for high inflation. It means high interest rates, and this could have negative impact on the region. It's a region where we see some positive signs in terms of appeasement, but any flare-up of tension could happen and also could have a negative impact. Therefore, it's an important year to observe in terms of how the economic fundamentals are moving, but it's a year to remain vigilant because risks are still tilted to the downside, and it's the time to double down on reforms and accelerate them in order to achieve greater stability in the region.
Also, just want to point out, in the report, there's an entire section devoted to countries that are emerging from conflict. So we'll talk about that later on the panel. Just as a quick follow-up, Jihad, is it fair to say that the region has been more resilient because the external shocks have not been as big as anticipated, or is the region more resilient because they've developed the tools to be more resilient?
Well, of course, the region is very diverse. And this diversity reflects a bit also on the way countries withstand the shock. For example, the drop in oil price was very positive for oil importing countries, but did not affect negatively oil exporting countries, especially the GCC, because the unwinding of the OPEC Plus brought 2.2 million barrels a day. Most of them came from GCC. At the same time, countries who had high level of debt or still have high level of debt, countries like Egypt, for example, and Jordan, are implementing fiscal reforms and that have led to improvement in their overall macro situation. And there are promises that investment in AI and technology could lift growth up. Let's not forget that among countries who are the most ready, 3 are from the region: Qatar, UAE, and Saudi. And I would like, if we have the opportunity, to discuss how those fast-growing, transformative sectors could also play a role in accelerating growth, increasing productivity, and above all, creating jobs. Because I think, although the situation has improved, but on inclusion side, there still need to deal with certain important issues going forward.
Okay, we'll address that later on the panel. Mr. Sultan, I want to ask you, you have a lot of visibility about supply chains, about trade, given the work that Agility does. There is one line from the report that caught my attention. Between January and May, the value of merchandise exports from MENA, emerging market and middle-income economies actually increased by 8% compared to the same period last year, underpinned by sustained trade with China and the EU, as well as continued expansion in intra-regional trade. What are you seeing?
I think there's two perspectives here. I think one is that what I would call the plausible or the realistic perspective, is the other is the plausible contrarian one. In terms of the realistic view, I think the GCC economies and the MENA are pretty well insulated from what's happening in the US and with the tariffs. General trade, I think, with the UAE and the US is about 5%, a little bit less than 5%. So you could say that we're pretty well insulated from what's going on. At the same time, we were assessed a business-friendly 10% tariff. So in terms of if you look at what's happening around the world, I think we're in a good spot and we are in a perfect position to mitigate the impact of what's happening in the US. So that's a plus for sure for the region. Secondly, and we should not underestimate the value of I would say, the non-aligned neutral posture of the GCC, the UAE in particular, is really going to be a positive for business going forward. You're able to do business with the US on good terms. You're able to do business with China on good terms. And basically, you're able to do so. And that is not a choice that major companies in many markets have. So if you're today a US company trying to do business, you have to choose. And oftentimes the legal environment is contradictory. So you have to choose between a law in one country and a law in the other country. That makes it very difficult to do business. And I think for that reason, the UAE and the GCC in general is perfectly well positioned for this tumultuous environment that we are operating in now. Clearly, there can be better synergy dividends from actually regional integration. I would not see that as a negative. I would see that as an additional layer of dividend, even add more to the story of the GCC and MENA. It's not a negative. It's something to still look forward to. I know that you guys are working on actually kind of extracting those dividends, and we all, will do what we can to help. On the regional, I would say, logistics front, there's been a lot done in improving the multimodal, I would say, infrastructure set that the governments have to mitigate crisis. And it started in COVID. We spent years going down the path of basically of globalization, focusing on cost and optimizing costs. And somewhere along the line, we forgot this issue of resiliency. And along came COVID, and COVID basically exposed how little resiliency was actually put into our supply chain. So the governments, I think, started at that time really investing in their multimodal infrastructure, airports, the shipping, the train networks which are coming. These are all in response to these crises. So, along comes the Red Sea. Red Sea would have been far worse had we not been through COVID. And even with the Red Sea, there's a lot of additional investment taking place. Major companies are putting logistics infrastructure in the Kingdom in Saudi Arabia and Jeddah to overcome future shocks. What I like about that is that if you take away the leverage of why these shocks were in the first place, they're less likely to come up again in the future. So I also think from the regional perspective, given the way that they are positioning for the future of AI, that's going to be an incredibly attractive growth story for the future of technology and investment. I mean, Saudi Arabia is looking at 50 gigawatts of data centers. UAE has a data center that's 5 gigawatts. Just to put that in perspective, the nuclear facility that was built roughly 10 years ago and still being expanded, that was only 4 gigawatts of power. So it really kind of crystallizes the opportunity that we have here in the Middle East. I will quickly, so in summary, being non-aligned, being neutral is going to have a major benefit for our part of the world. Now the contrary, and I'll keep it short so we can move on this. So the GCC sovereign wealth funds are well diversified, but they will be impacted by tariffs. Tariffs will lower growth and will impact, to a certain degree, those wealth funds. AI will impact employment. We're already seeing that. So the prospects for younger graduates are much more difficult. You can see banks refraining from hiring analysts because they can actually replace those analysts with AI. Already this is taking place. We also have, in the US in particular, with the tariffs, companies have been reluctant to actually pass those prices on immediately to consumers. And if you guys remember what happened to Walmart, immediately after tariffs were introduced, they put up their prices and they got a call from the White House that says, guys, don't do that. So companies in the US are going to bring these price increases to bear. It's going to lead to inflation. We're not seeing the full effect yet. They will come to bear. And then you have this issue of the US basically maybe picking up the phone and said, we might need lower energy prices to keep inflation in check. So I think all these things could have a difficult kind of prospects in the future. I'm still projecting growth, but these are just things to watch. Sorry.
Something to watch out for. I worry about AI replacing jobs, hopefully not my one, in the next few years. Dr. Saeeda, I want to pick up on something actually that she had referenced, which is the fact that cumulative bond issuance for MENA countries has exceeded 36.8 billion. That's up until September, nearly matching all of 2024 for the year combined, i.e., even in an environment of these external shocks, of trade uncertainty, there was plenty of issuance coming through from the region, no issues at all funding that issuance. We still see financial conditions being pretty loose, pretty supportive. Were you surprised at how resilient emerging markets have been as a whole, and specifically how resilient this part of the world has been?
There we go. Technology isn't always what you think it is. Actually, the numbers are extraordinary. If you look at January through September, you're talking about 126 billion. That is an all-time record. And if you go back and you ask yourself, well, what is the global environment? If you look at indices of trade uncertainty and economic policy uncertainty, they've peaked, primarily because of what the US is doing under Trump. Number two, if you look at debt and growth of debt and risk in the financial markets, again, mainly US, Europe, again, very high. And if you look at some of the numbers in terms of growing deficits, the pointers are that you might have a financial crisis. We don't know yet. Number three, geopolitical risks, particularly for our part of the world, are also practically at a high. So what is extraordinary is that you've got growth. IMF is cautiously optimistic, so they don't like to go. I can go a bit more. You've had the growth despite all this. And so you ask yourself, would you be surprised if you started the year and said, those are three major sources of uncertainty, what do you think is going to happen? Your guess would be lower trade, lower economic, lower oil prices, etc., for all those good reasons. And yet that has not happened. Am I surprised? No. So let's dig in. But primarily, I think we need to understand that the landscape is very varied. You need to talk about the GCC and oil producers, the non-oil producers and importers, and then all the rest, including what you mentioned a bit earlier, countries coming out of conflict. And we need to focus on those. Maybe we can do that later. But let me focus a little bit on the GCC because there's a very positive story. And it builds on macroeconomic fundamentals, which have been very strong. You've got basically macroeconomic policy, which has been very stable and accompanied by political stability. So that gives your building block. But second, and this is where it's interesting, is greater diversification. And 4 elements of diversification. Number 1, output diversification. You're no longer into oil and gas. If I look at UAE and you look at Abu Dhabi, oil and gas is no longer the primary sector for the UAE. It is non-oil. So output has become diversified. You move towards services, manufacturing. Second, trade diversification. And unlike the rest of the world, if the rest of the world wants to fragment, the UAE and most of the GCC is going in the other direction. They're going towards greater integration in terms of trade. And in particular, insofar as China and Asia is concerned. That is a very positive factor. So you got trade diversification, which is increasing. And the third element, extremely important for macro stability and sustainability, is revenue diversification. What's happened over the past 10 years in the GCC is you've varied revenue. You now have VAT, you have other taxation, corporate taxation. So now you have more stable sources of revenue. And the fourth element is digitalization. And here you need to distinguish between digitalization and digitization. Digitalization forces you to review all your processes, and that is coming in. So you've got the forces of AI, you've got investment in high-tech sectors. The combination of those factors means that you've become more resilient than you've ever been to global shocks as well as to regional shocks. 2 other elements I think are important. The GCC in particular, I call them the GCC falcons, just like the Asian tigers. They are maturing economies. They no longer are what they were 10 years ago or even 5 years ago. And the COVID shock made a big difference because they've gone from economic diversification 1.0 to economic diversification 2.0, going into technology and the rest. Tarek was starting to mention data centers and getting into it. Massive investments in data centers, but what's interesting about it is that in this part of the world, they can be green data centers. Data centers use a great deal of energy. And so if you can solar power them, you can have green data centers. And this is the only place in the world where you have both of them. 2 other things. And people don't realize how important that is. If I look, say, at Abu Dhabi, income from foreign assets and sovereign wealth funds is now greater than income from oil and gas. It's greater than income from oil and gas. So you're no longer vulnerable to the price fluctuations as you were before. Additionally, you now have yourself in a very, very sweet spot where you're a global hub for traditional energy, oil and gas, but now you've become a global hub for renewable energy, clean tech, and climate tech. No other region in the world combines the 2. So as the US withdraws from renewable energy and the like, we advance. Europe is no longer talking about the green economy. They're talking about defense spending. All the better for us, because I think what it means is that we will be global champions for climate tech, clean tech, and the like.
Fascinating. I'd also never heard the term the GCC Falcon economies. Is that
Yes.
your term?
That's something I
It's a good
invented
one.
invented 2 years ago.
I like the Falcon economies. Jean, I want to turn to you, and maybe this. Feel free to pick up on anything that the prior speakers have talked about, but I did want to also ask you about just one of the other macro themes this year, which has been the real depreciation we've seen in the USD. We're about 10% weaker year to date. And what sort of ramifications do you think that has had on this region, given so many of the currencies of the region are pegged to the USD? Has it been a tailwind or a headwind because it entails importing inflation? To Jean.
Although if you want to answer, you're welcome too. Yeah, so it's been actually decades since we've seen such a sudden, large depreciation in the USD, 10, 11% in 6 months, yeah. And so, of course, that raises eyebrows and raises questions about what we should make of it. For me, one interesting thing to think about is the reason why this depreciation happened. So what can we figure out about the triggering factors of currency movements? This is a big one, and they're essentially a benign explanation, a middle-of-the-road explanation, and a pretty scary explanation. The benign one is based on the notion that the rest of the world is growing faster than the US, and so naturally the USD depreciates because it becomes a less attractive economy. Now that's probably purely abstract because we already know this is not exactly what's happening. The US is growing at 3.8%. So the reason why we see this depreciation has to be found on in a specific kind of asymmetry where it's that the prospects of the US have worsened while potentially the prospects of the rest of the world stayed the same. So it's not going to be a story that's going to be very positive. It's not going to be a story where the USD depreciates because the rest of the world is doing well. It's not going to be a China story in 2000 where China actually pulls the world economy and demand for commodities, the prices of commodities, and the USD depreciated to an extent. So there's two explanations, one that is short run and another one that is long run. Both of them are relatively problematic for the world economy. The short run one is there's some worries about fiscal policy in the US, the debt burden of the US, potentially some worries that calls potentially for a third type of explanation that at least partly may be relevant, and that's the scariest one. It's one that is reflecting worries, structural worries about policy in the US, about structural change, abrupt changes in policies in the US, whether it be fiscal policy or monetary policy, for example, questioning the independence of the Fed. And then if the depreciation of the dollar comes from this type of considerations, then it becomes much more worrisome, because then what it suggests is potentially flight for safety. The fact that risk aversion increases suddenly, quite abruptly, potentially because markets correct themselves downwards. That, in this case, would be bad news for the region, because the depreciation of the USD still potentially has pro-competitive effects on the region's exports. The region's exports become cheaper. But that's completely offset by the fact that the world economy would probably start contracting under that scenario. So the value of exports would fall, the price of oil would fall, investments would retrench, probably to Switzerland or to gold. And we've seen some of these phenomena at play, which suggests the cursor between this depreciation be good news and bad news for the MENA region is really somewhere between my second and my third scenario. One that might reflect some temporary worries about short-run policies in the US, which remains benign and potentially pro-growth for this region, or a scenario that's more catastrophic, where the worries about the US become long-run worries about the structure of the economy.
Yeah. Jihad, I want to come back to you and just, one of the takeaways of the report is even though you have upgraded your growth forecast, you still talk about downside risks as well. And I wonder how economies should be thinking about the trade-off between supporting their economies now and building buffers for the future in case shocks actually materialize in the next couple of years. How do you think about that trade-off from the perspective of the IMF?
Well, maybe there is an apparent contradiction, but in reality, they complement each other. Why we are cautioning countries? Because for two reasons. One, our research is showing that uncertainty could materialize over time. That we may not see it today, but it may come in 6 months or 12 months. And I refer you to the Rio Regional Economic Outlook of April, where we measured this. Therefore, we are very much concerned that what we see today could show negatively in 6 to 12 months. The second thing is policies are not settled yet. Trade policies are changing still. Even what is one of the key sectors in the region, which is the oil sector, things are not stable. We have an acceleration of the unwinding of the OPEC Plus that is leading to potential excess supply in oil. And any drop in demand could create a glut. Therefore, it's very important to remain cautious. But which is the second element, is there is a great deal of synergy between stabilization and acceleration of recovery. Stabilization meaning you put inflation under control, which will help you gradually improve your external balances, reduce your interest rate, and will increase the capacity for you to attract investment. By doing so, it releases certain resources. Instead of paying debt service, you can invest in technology in order to accelerate the transformation of your infrastructure and become more competitive and increase productivity. Productivity is one of the issues that the region is lacking behind other parts of the world and emerging economies, both labor productivity and capital productivity. Three, that is also very important, is by reducing the size of the state, you not only improve your overall public finance, but also you create opportunities for the private sector to come in. Countries like Egypt, where 72% of the SOEs are in the commercial business, it's definitely here you have large space whereby you can bring the private sector in, give more space to the private sector to create jobs. The last point is improving access. Access to capital, access to finance in a region that still, in comparison with other emerging economies, we are still low, relatively speaking. SMEs have access to finance around 5-6% of GDP, while on average for EMs we are at 16%. Access to knowledge as well as also access to talent. This would have win-win. It will improve your economic performance and will allow you to strengthen your inclusion by creating more jobs for the youth and increasing women integration into the economy. Saudi did a great job over the last 7 years. Despite the COVID shock and the various successive shocks, unemployment went down to historical low level, and women participation in the economy moved up from 16% to 36% in less than 6 years. Therefore, you have a great deal of baking your cake and eating it, improving your macro fundamentals and increasing growth. And I think this is where the region stands today to address those two priorities at the same time.
Nice. And Mr. Sultan, earlier you were talking about one of the things that stood out to me from what you said is this policy of non-alignment in the region, and that you've seen it as a relative benefit for countries in the region. As we talk about the potential for further global economic fragmentation, further geopolitical fragmentation, what do you see the region doing specifically to take advantage of perhaps what that might mean for the rewiring of global value chains and supply chains?
That's a great question. I think there's a few areas I would look at first at kind of the human capital cultural adaptations that need to take place and that are taking place. I think one is the transition of government from being a doer to an enabler. And this is, I think, something we've combated in the past with large government has tended to crowd out private sector investment and basically create a private sector that was kind of a rent-seeking private sector. I think what's driving things now is the scale of the opportunity is so large. If you all you have to do is look at Vision 2030, and you might say, wow, that's really ambitious. But the flip side of that is that no government has all the resources it needs to actually do something that ambitious. So the government has to transition itself. If it wants to meet its objectives and wants to meet its vision, it has to transition itself to doing less and allowing the private sector to do more. That's a big change. And I think we need to do more to enable that process. The other is the perspective of the citizen as an enabler to that growth and that opportunity. There's been over time, people think of citizens maybe as being a source of leakage for public funds. And I think going forward, that's going to need to change. We're going to need to look at individuals as really being the engine and drivers of growth, and what that means in terms of government policy and how they do that. I would also say this transitioning the private sector from a private sector that was risk averse and rent seeking to a private sector that is actually embracing a change and risk will fundamentally change the ability of the economy here to benefit from all the changes that are taking place. That's, I think, something that should not be underestimated. I would also, on that front, I'd also focus on the government's, the quality of the government's regulatory resources. Given that things are changing so quickly and the pace of change of technology is so great, it's more important now than ever to have that talent in the government. And I'll give you a couple of examples of things that I came across personally that kind of might make this point clear. We were working with a U.S. company that's come up with an innovative way to do a blood biopsy that detects cancer. So this technology has only been available in the U.S. for the last quarter. So when we went to speak to the regulators here, they actually had a guy that had his PhD in this field that was already part of the regulatory framework. So you can imagine the discussion that you have with the regulator basically enabled all of the opportunity to be captured by the government, whereas a few years ago, that sort of opportunity would have just flown out the window. So that's one example. The other is, there's in Abu Dhabi, for example, the regulator in the healthcare sector is an engineer, which is, it sounds strange, but engineers, I think, are people that are driven by data and analytics, and therefore they're much more tolerant to risk and risk-taking, and they're less caught up in these protocols that they were taught in med school 30 years ago. So having that sort of human capital inside the government magnifies the opportunity of the economy to absorb this technological change and maximize the opportunity. And then I think the last part is the changes that I highlighted above will also help maximize the output of the education system. Governments in the GCC are spending per capita more than any countries on education, yet the output of that education is not giving the benefits that you would desire, because of the, I would say, I mean, who's going to really excel at school if they don't think their job in the future is going to depend on it, okay? Anyway, so these are, I think, a couple of areas. I just have one more because I want to get it.
The anecdotes are good. Or perhaps we can come back to it. Yeah,
yes.
we'll come back to it. Dr. Sarki, let me, I actually had a look at one of your own team's reports, and I want to pick up on something that Jean mentioned, which is, fiscal risks and specifically public debts in the region. This is from one of your own reports. It has been rising for almost a decade. More than half the countries in the Arab region have higher than pre-pandemic debt to GDP levels. Amongst the GCC, Bahrain's public debt as share of GDP is the highest. It's around 142%, while Oman actually it's dropped quite a lot. It's from 70% in 2020 to 35.1% in 2025. We've also spent a lot of time talking about the record amount of issuance this year, the fact that these deficits, specifically in Saudi Arabia, have been moving wider and wider. What is your level of concern today about the trajectory of public debt that's being taken on in the region?
Right, let's put it in perspective. So Bahrain has a relatively high level of debt. All the other GCC countries in particular have relatively low levels of debt. We're talking about 30, 40% at best. But one mistake I think we make is to forget the other side of the balance sheet. You've got assets. And one thing that's very interesting about the way the GCC countries manage their public assets is that they are very efficient in managing their public assets. And so now you have privatization also happening. Look at Aramco, look at ADNOC, look at all those. In the future, you might have other assets. I don't know. I don't want to speculate. Other assets coming onto the market. This is happening at a time at which appetite for GCC risk has been growing. Remember that, I want to come back to your question about the dollar that you asked. There is de-dollarization happening, and for good reason. Economic risks, the weaponization of the US dollar. You look at how the big shift in reserves has happened. Look at gold. It's now close to 27, 28% of international reserves. So part of that is shifting away from the United States because you look at riskiness of US assets, potential sanctions and all the rest. That's driving capital flows into emerging markets. And we are extremely attractive from that point of view because you've got enormous natural resource wealth, you have sovereign wealth funds and enormous foreign assets which are generating income. And at the same time, there's been reform in terms of allowing greater access, in terms of allowing foreign investors to come into markets. So all of that, I think, is driving the story of greater attractiveness of assets from the region. So although we point to the fact that you have to be careful in terms of managing debt, and I would, for example, advocate that you should have public debt offices. That should be something on the agenda. You need to look at macroprudential measures and reforms that need to be taking place. Developing your mortgage markets, property markets, corporate debt markets, government debt markets, because we point to the fact that fiscal policy on its own cannot function independently of monetary policy. You need coordination between the two. So although we call for maybe having active monetary policies, the instruments that you currently have are just reserve requirements and interest rates. You need to complement that by having, for example, being able to intervene in functioning debt markets. So you can do QE as happens elsewhere. We're not into that yet. So macroprudential, developing pension systems, developing the corporate debt market gives you a lot of depth. So as you do that, you're attracting more and more investment into it. And The digital aspect, I think, is very important. Jihad was starting to point to that. The digital economy and digitalization allows for greater financial inclusion. So if I look across the GCC, you have a large number of expatriate and a large expatriate population which works here and then remits outside. What you should be doing is working to keep those remittances in the country. So pension systems can help, but also having well-developed debt and equity markets would retain the savings rather than remitting them outside. So the picture I'm saying is not simply just focus on debt. Look at how you manage your public assets. In many cases, the public assets that you have, and particularly commercial public assets, can be a great source of income for governments, and we tend to neglect that. So take a balance sheet approach, look at how you manage your public assets, and you can earn a lot of income from those public assets. Anybody who lives in Dubai knows about SALIC, and the same is true. This is steady sources of income, and it means if you manage those public commercial assets intelligently and efficiently, then you can generate a great deal of revenue from that. And it allows you over time to have more sustainable public finances. They've already started that by reducing subsidies. UAE is at the forefront, particularly insofar as fuel subsidies are concerned. That's a major area for many of the oil producers, reducing subsidies for fuel and maybe other subsidies, and having more rational social protection programs.
Jean, I want to round up, this round of discussions with something that Jihad referenced, which is, the productivity challenge. And what do you see as the biggest levers to unlock the productivity potential in this region?
That's a deep question. So the story of economic growth, the way in which countries become rich, as I think Jihad mentioned, is through productivity gains. That is, people become more productive, their wages increase, their income increase, and the economy expands as a result. And that is typically accompanied by technological progress. So for 200 years, we've had unprecedentedly high rates of technological progress that seem to be culminating today with AI, at least it's the latest incarnation. And for 200 years, technological progress has created jobs. And so there's an open question that one hears frequently, which is that this time it could be different. AI is a form of technological progress that has no precedent in history, and perhaps for the first time in the last 200 years, we have a version of technological progress that is actually going to destroy jobs, unlike the previous incarnations. So for me, the thing that I really would like to say and repeat as much as possible is that technology eventually creates jobs. There's a vast amount of data and history to show that. So at worst, technological progress may actually destroy some jobs for some of the time. And so what you don't want to do in terms of policy making is to let this state of affairs hijack technological progress. That is, you don't want to have policies that are going to limit the extent of technological progress on grounds that temporarily some jobs may disappear. So I think the answer at a deep level to your question is, one, you want to have a system of job protection, of job education, of short-term education, perhaps focused on the unskilled and the young, that makes sure that the amount of jobs that get destroyed is as limited as possible, and also that the opposition to technological progress, politically speaking, is as small as possible. What you don't want to do is to limit the extent to which technology increases productivity.
Yeah.
The second thing that is quite important historically again is that the way in which typically technology increases productivity is a new technology get introduced. It makes people more productive. If those people actually can benefit from their increased productivity, that is, if their wages increase as well, then we're in a virtuous circle where technology sustains itself by creating higher wages, which in turn creates higher demand, which in turn creates more jobs. But for that virtuous circle to actually obtain, what you need is for the rents created by technology to actually be redistributed, to be paid in the form of higher wages. If the rents of technological progress are confiscated or monopolized by the Jeff Bezos or the technological moguls, then you have a problem because there's reasons to expect that wages don't increase, which breaks that virtuous circle.
Yeah. We've got a couple of minutes. Did you want to jump in? I've got just a few minutes left. If you want to jump in, and then I want to ask one last question. Yeah.
I'll be very quick. The issue of trade facilitation, I think, is really important. We all remember, even before COVID, the WTO and globalization was really under attack in the media and by most economies. What happened during COVID were there thousands of new impediments to trade that were introduced around the world that had the effect of making trade much more difficult. Of course, with the current round of tariff wars in the US, you can imagine what that means for SMEs. They are not equipped to handle that complexity and all these new rules. Larger companies, together with AI, are able to manage and improve their profitability. But what we need to do to take advantage of this opportunity is we have to start looking at trade from the perspective of SMEs. And I think that's when we look at the way we're integrating, or hope to integrate the MENA region, I think one of the main points on the agenda should be how do we get the SMEs into being part of this process.
Yeah. So final question for Jihad and Dr. Saidi, and I know we don't have a lot of time, but it is very important. The chapter that you devoted in the report to countries that are emerging from conflict, whether that's Lebanon, Syria, hopefully Gaza, and your analysis shows that economies experiencing higher volatility in the first 5 years of peace are less likely to achieve a successful recovery. So could you just comment on some of the takeaways for the research that IMF has done around some of those countries emerging from conflict? And then I know, Dr. Saidi, you've also calculated some economic figures to wrap the reconstruction ask right now.
Well, we are in a moment in the history where we have more than one country coming after a conflict. And those countries have been suffering for decades. And I think it's a great opportunity to see how we can help those countries benefit from the experience of others in a world where capital has become more difficult, especially in terms of international assistance. And there are lessons that have helped countries accelerate their capacity to recover. One is investing in some of the key social areas pays off very well and very quickly. Education, health, housing are very important. Therefore, gear your public spending toward providing the minimum social support for people to focus on producing. Two, strengthen your institutions very quickly. This is the best way for you to manage and run the whole transformation, become more credible and attract assistance and investment. And three is make sure that you preserve your macroeconomic stability, because otherwise, while trying to accelerate the recovery, you could create additional instability. The additional element that is important is it's not a one country play. And it's not one actor play. What I mean by that, the synergy that could be created by making sure that all these countries in post-conflict creating additional value by strengthening the regional coordination, and restoring connectivity that existed in the past as a way to accelerate. Two, it's not only about public money. Private money will play an important role, especially countries who have a deep and strong diaspora, that it's not only able of bringing money, but also bringing know-how and talent. And stabilizing those countries would be an additional factor in order to deepen something that is very important in the region, connectivity and integration. In the world where we see a lot of uncertainty and fragmentation, what you need to do is you need to connect with new partners. And this is something that we see in the GCC, more connectivity with Central Asia, for example, or Africa. Connectivity is very important. And at my left, we have a champion of connectivity and integration. It's very important. Starting from here, from the GCC, deepening financial integration, deepening trade integration will grow the market, but also integrating with other parts of, I would say, the wider region would be an opportunity to create additional growth and additional job. I would like to underscore this job issue today because the region is young and has a lot of talents, and we need to provide access to those new talents, because otherwise we are going to create a generation that is well educated in a world where technology is going to be shifting dramatically the way we work without benefiting from those. Therefore, investing in that, it's not only for creating additional growth, but also additional stability. And this is my last word. Thank you. Dr. Said.
What can I do to build on that? I think the following is important. It is in our interest that we have regional stability. And that regional stability is linked to not only reconstruction, but actually redevelopment of many of the countries that were destroyed by violence, war, and conflict. When I look at that landscape, let me just remind ourselves what we're talking about. Gaza and Palestine, Syria, Iraq, Lebanon, Libya, Yemen, Sudan, and the list might be longer. By my estimate, the reconstruction costs are probably running at around $1.5 trillion. Now, that looks like a big challenge, and it's both a public challenge. You need a lot of official aid, debt relief, and the like, but you can also attract a lot of private capital for reconstruction. Look at, for example, what's happening now with Syria. And I think what's interesting for us, particularly in the GCC, is that investing in regional stability means your growth prospects can improve. You need to integrate those countries into the region. This is what I call regionalized globalization. The GCC countries are already globalized. Many of those countries we're talking about, including Egypt, is not as globalized as the GCC. But through regional integration, infrastructure integration, economic and trade integration, then you're allowing them to become globalized. They have improved growth prospects. You create the jobs that Jihad is rightly pointing to. And it's not only the jobs, we have lost generations. There are generations that have been lost, people displaced. We have the highest number of refugees per capita in the world. We need to address those because those are big risk factors. We cannot afford to neglect that. And I know Jihad and the IMF and international institutions are now focusing on that. But I think this is one of the biggest challenges we have over the coming years and decade, along with climate change. I think those are two big challenges in front of us that we need to address. So at a high level, policy-making level, reconstruction and redevelopment, because it's one thing to rebuild infrastructure, it's another thing to redevelop economies that have been destroyed. So it's reconstruction and redevelopment. Those two have to go together. What I'm optimistic about is that if we put this on the policy agenda, then what you have is potentially a new Middle East emerging and very promising.
That's a wonderful place to leave it. Gentlemen, thank you so much for your participation. I'm sorry we went a little bit over, but I thought the last couple of questions were also very important and relevant to our discussion today. Thank you all very much. Thank you.